everyone, and welcome to Behind the Tax Case, where we break down the real tax cases in a simple and engaging ways. I'm Nazmira, your host for today.
I'm Rashizani as your tax consultant.
Hi, I'm Shaira as your tax analyst.
Hi, and I'm Akila as the legal and ethics expert for today.
Today, we will be discussing the landmark case Malaysia versus Watson's Personal Care Stores Holding Limited 2023. We will explore the background of the case, the tax issue involved, the court's decisions, and most importantly, the lesson every taxpayer can learn from it. Okay, so let's get into discussions.
Let's go.
Okay, Shahira, can you briefly explain the background of this case?
Sure. This case involved the Director General of Inland Revenue representing the Inland Revenue Board of Malaysia and Watson Personal Care Store Holding Limited. Watson borrowed money from its related company, Watson Labuan, to finance the acquisition of share in related companies. The loan carried an interest rate of LIBOR of plus 3% per year. During a transfer pricing audit, the IRBM questioned whether this financing arrangement comply with the arm's length principle under Section 140A of the Income Tax Act 1967. The IRBM concluded that the loan was not conducted at arm's length. This allowed the interest expense claimed by Watson and issue additional tax together with penalty. However, Watson appealed to the Special Commissioner of Income Tax, won the case. When the IRBM appealed to the High Court, the appeal was dismissed.
Such a great explanation. Akila, what was the role of IRBM in this case?
Actually, the IRBM was responsible for auditing the Watson's tax compliance. They reviewed the related party loan transaction and believed it violated the arm's length principle. Therefore, they rejected the interest deduction and imposed additional tax assessment. However, the court later ruled that IRBM failed to provide sufficient evidence to justify its transfer pricing adjustment.
Okay, Wani, what were the major tax issues in this dispute?
There were four main issues. First, whether the interest rate of labour plus 3% comply with the arm's length principle. Second, whether the interest expenses were deductible for tax purpose. Third, whether RMBM properly exercised its powers under Section 140A of the Income Tax Act 1967. And finally, whether RMBM had sufficient evidence to support its transfer pricing adjustment.
Okay, so Shahira, why are these issues important for an audit perspective?
Because related party and cross-border transactions are considered high-risk area during tax audit. This case reminds taxpayers that transfer pricing documentation is extremely important. Without proper documentation, company may face additional tax assessment, penalty and lengthy dispute with the IRBM.
I see.
Let's move on to the arguments. Akila, what was the Watson's arguments?
Actually, the Watsons argued that they had prepared complete transfer pricing document including the benchmarking studies and economic analysis. They showed that the interest rate of labour plus 3% reflected the market conditions and therefore complied with the arm's length principle. They also argued that Section 140A only allows IRBM to adjust prices, not to completely disregard a legitimate business transaction.
Okay, so Wani, what about IRBM's argument? What do you think?
RMBM argued that no independent company would agree to such a loan arrangement because there were no strict repayment terms. Therefore, they believe the transaction like a commercial sustain. As a result, they reduced the interest zero and disallowed the entire interest deductions.
Okay, so Shahira, in your point of view, who presented the stronger arguments?
In my point of view, Watson had the stronger argument because they supported their position with proper documentation and evidence. Meanwhile, IRBM failed to provide an alternative arm length analysis or sufficient economic evidence to justify their adjustment.
I see.
Okay, so Shahira, what did the High Court decide?
The High Court dismissed the IRBM appeal and upheld the SCIT decision in favor of Watson. The court ruled that IRBM failed to prove that the transaction violated the arm length principle.
Furthermore, the court also emphasized an important legal principle. Although RMBM has the authority to adjust related party transactions, every adjustment must be supported by proper economic analysis and credible evidence. The court found that replacing the interest rate with zero without determining an appropriate arm length rate was legally incorrect.
Okay, so Akila, do you think the decision was consistent with the Malaysia tax law?
Actually, yes. And the decision supports the objective of Malaysian tax law by promoting fairness, transparency, and legal certainty. It also reinforces that tax authorities must exercise their powers according to the law and cannot rely on assumptions alone.
I see. Okay, so next, tax audits and investigation implication. So, Wani, how does this case affect future tax audits in Malaysia?
The case encouraged evidence-based tax audits. RMBM auditors must perform proper transfer pricing analysis instead of making unsupported adjustments.
It also reminds companies to prepare comprehensive transfer pricing documentation because related party financing arrangement will continue to receive close scrutiny during tax audit.
So, Akila, what is documentation is so important?
Actually, it is because the documentation is often the strongest evidence during a tax audit. Documents such as transfer pricing reports, benchmarking studies, loan agreements, financial analysis, and supporting records can determine whether a taxpayer succeeds or loses in dispute.
Okay, so Shahira, what do you think the practical strategies can taxpayer adopt to minimize tax dispute?
The taxpayer should maintain complete record, prepare transfer pricing documentation, file accurate tax return on time, conduct regular tax review, and seek professional tax advice whenever necessary.
I see.
So, Wani, how do ethics and good tax governance help?
Professional ethics encourage honesty, accountability, and transparency. Good tax governance ensure company comply with tax laws, reduce tax risk, and maintain a good relationship with the RMBM.
Okay, so what happens if taxpayer fail to comply?
Actually and legally, they may face additional tax assessments, penalties, tax audits, and prolonged litigation. Ethically, non-compliance damages a company's reputation, weakens public trust, and reflects poor corporate governance.
Oh. Okay, so before we wrap up, let's share our recommendations.
Companies should prepare comprehensive transfer pricing documentation before entering the related party transaction.
They should also establish strong internal tax governance, conduct regular compliance reviews, and identify tax risks early.
In addition to that, businesses should seek professional tax advice, maintain proper records such as contract, invoices, loan agreements, benchmarking studies, and also financial statements. For example, if a Malaysian subsidiary borrows from its overseas parent company, it should prepare benchmarking studies to demonstrate that the interest rate reflects the market conditions before the IRBM conducts an audit.
Okay, to conclude, the Malaysia versus Watson's Personal Care Stores Holding Limited 2023 case highlight the importance of complying with transfer pricing rule, maintaining proper documentations, and practicing ethical tax governance.
It also reminds us that tax authority must support every transfer pricing adjustments with strong evidence and proper legal analysis.
For a taxpayer, good documentation and professional advice are the best defense against tax dispute.
Ultimately, this case promotes fairness, transparency, and accountability within Malaysia's tax system.
I think that's all for today's episode of Behind Tax Case. Thank you for listening, and we hope this discussion has helped you better understand one of Malaysia's most significant transfer pricing cases. Thank you. See you in the next episode.
See you!